So one of the fundamental accounting standards that you need to understand is IFRS 13, that is fair value measurement. This is important because it is an accounting standard that is actually going to be running through the entire discussion when it comes to financial reporting and corporate reporting. But the question we ask ourselves is, what is the guiding principle for determining the fair value of an asset or a liability as stated in IFRS 13 fair value measurement? To answer that question, we first have to define what fair value is. According to IFRS 13, fair value can simply be defined as the amount to be received or payable for an asset or a liability between market participants. So if I have a certain asset, or let's say I have this phone, what is the value at which I can exchange it for money? Or if I owe somebody, how much do I have to pay the person to settle the debt? That becomes what we mean by the fair value. But a big question we then have to ask ourselves is, how do we determine the fair value of an item? The standard gives three-level category or guiding principle for determining the fair value of an asset or a liability. The first level is to use the quoted price of the asset or a liability on the market. And so if there is a market in which the asset is being sold, then certainly we can use the price at which the asset is being sold to determine the fair value. But it is then important for us to understand that IFRS 13 further talk about principal market and the most advantageous market. If we are going to determine the fair value of an asset or a liability, then the first thing we need to ask ourselves is, what is the principal market of that asset? The principal market refers to a market with the greatest volume and activity levels of the asset in question. So let's give an example for this. Let's say that we are a company that sells sanitary pads, and we sell sanitary pads in Ghana, we sell sanitary pads in Nigeria, we sell sanitary pads in Cote d'Ivoire, and we are in Ghana. So it means there are three major markets within which we are selling our sanitary pads. And so if we have closing stock of inventory of sanitary pads and we want to determine the value at which we're going to be carrying this in our books, the guiding principle is that we need to identify what is the principal market, the price at which the goods is being sold in the principal market will then be the guiding rule for us to determine the fair value at which we will carry our sanitary pads. And so the principal market is the market with the greatest volume and activity level. Please be careful. The principal market is not the market in which the reporting entity sells majority of its items. No, it is actually the total size of the market. And so if we have Ghana and total sanitary pad sales in Ghana, not the company's sanitary pad sales, but the entire sanitary pad market in Ghana, it's say 500,000 packs. In Nigeria, it's 700,000 packs. In Cote d'Ivoire, it's maybe 300,000 packs. Then which of the three has the greatest volume and activity level? It will be the 700,000 packs, the Nigeria. And so that is how we identify the principal market. But where there is no principal market, IFRS 13 went ahead to say that the entity can use what is referred to as the most advantageous market. Now, the most advantageous market is simply the market which maximizes the amounts to be received or liabilities to be settled after taking into consideration transaction cost and transport cost. What does that mean? And so where there is no principal market, then we would have to find out, okay, which of the markets will give us the highest amount for this asset that we are selling. So if we go back to our illustration earlier, we are selling in Ghana, we are selling in Nigeria, we are selling in Cote d'Ivoire. Now, none of these markets can be determined as the principal market. And so in that case, IFRS 13 says that we have to use the most advantageous market. The most advantageous market is simply the market with the highest net cash flow after we deduct transport and transaction cost from the selling price of the inventory. So that is what we need to understand between the principal market and the most advantageous market. Now, this is important because sometimes in the context of the question, we will not be given directly the fair value. And in such cases, we would have to come to the principal market to be able to make a decision depending on the context of the question, or where we cannot determine the principal market, we will use the most advantageous market. And that is simply your net cash flow, which is the selling price less transaction cost and the transport cost. So that among the markets, the one that gives us the highest net cash flow, that becomes the value we will use to value our closing inventories or determine the value of the asset or liability in question. So that is what we must understand in level 1. We use the price in a quoted market. But sometimes the standard also says that the asset in question may not have a market. In other words, we cannot get a principal market, neither can we even determine a most advantageous market. In other words, that asset has no ready market. In such a case, we go to the second level, and that is where we will use the fair value of similar assets. Fair value of similar assets to determine the value at which our assets will be carried. So I use this example to explain to you. Android phones, for instance, a Samsung phone, the resale value on Samsung phones is really not there. In other words, there is not much resale value, there is not much active market for Samsung phones. But the Apple, that is iPhones, they have a high resale value, they have a high second-hand market. And so if we want to determine the fair value of this particular phone here, it will be difficult because we cannot get a primary market, we cannot get a most advantageous market, but we want to determine its value. So what we will do is we will go to Apple and then pick an iPhone, and so we'll look at an iPhone 15 Pro Max. Okay, their functionality, iPhone 15 Pro Max and the Samsung S24 Ultra, whatever. Maybe we can compare the two. Okay, so maybe this Samsung device is 6 months old, iPhone 15 Pro Max, 6 months old, the same range, that kind of thing. Then we ask, okay, how much will an iPhone 6 months old 15 Pro Max be sold for? Once we determine that price, then we can use that price to place a value on our Samsung device. That is the second level, using the fair value of similar assets to determine the value of the asset or liability in question. That is the second level. And so where we cannot determine the principal market or the most advantageous market, we use the fair value of other similar transactions, similar assets to determine the fair value of our assets. But sometimes it's difficult because there's no primary market, neither there is a similar asset or similar transactions whose value can be determined. And so this is where we go to the third level, and in accordance with IFRS 13, the third level is where we look at information relating to the asset in question. And then we will use that information relating to the asset in question to be able to determine its fair value. So let me give you an example. Let's say that a company has a land, and the fair value of the land is, say, whatever, $500,000. Stay with me carefully. So a company has a land, the fair value of the land at the reporting date is $500,000. But stay with me. If the entity developed the land into a residential property, then the land will now be valued at $2 million. But then they will have to incur a cost of, say, $400,000 to be able to ensure that that particular development goes through regulatory requirements. And so the question we then have to ask ourselves is, what is the fair value of the land at the reporting date? Is it the 500,000 or the value of the land after the redevelopment? IFRS 13 states that we would have to use that additional information provided to determine the fair value of the land. So although the land's fair value is 500,000, the redevelopment tells us that there is better potential for this land. For that reason, the fair value of the land will be the value after the development 2 million less the 400,000 cost that the entity is going to be incurring to get an approval for the redevelopment, so that the fair value becomes 1.6 million at the reporting date. And that is how you measure or determine fair value of assets and liabilities. So level 1, we use the quoted prices in the market. We have to be mindful of the principal market and the most advantageous market. Level 2, we use the fair value of similar transactions or similar assets to measure the fair value of the asset or liability in question. Then level 3 is where we use information relating to the asset specific, where there is an alternative use for that asset. For that reason, we use that alternative use data to be able to determine the fair value of the asset or liability in question. And this is what you must understand when we talk about IFRS 13 fair value measurement. Let me know in the comment section any other accounting standard that you want to see me providing you with some crash course key principles on, so you can put yourself in the better position to pass the examination. Remember to subscribe, follow, like, and share this video, and I'll see you in the next one.